Welcome back to the Book Digest. In today's episode, we're diving into a book that Warren Buffett himself calls the best book on investing ever written, Benjamin Graham's The Intelligent Investor. And trust me, this is way more than just a book about finance. It's really a blueprint for making rational decisions in the wild, often chaotic world of the stock market.
So, let's just jump right in with the most important question Graham asks. It's a question that basically defines your entire journey in the market, a real question of identity. So, which one are you?
Graham draws a really clear line in the sand here. The speculator, they're obsessed with the ticker tape, right? They're betting on short-term price swings, always asking, is this stock going to pop tomorrow? The investor, on the other hand, is playing a totally different game. They look straight through the price to the actual business, asking, hey, is this a solid company that's worth more than what the market is saying right now?
And just to be super clear on this, Graham gives us this three-part test. He says a real investment has to be based on thorough analysis. That means you've actually done your homework. Second, it has to promise safety for your original capital. And finally, it needs to offer an adequate, a satisfactory return. If it doesn't check all three of those boxes, well, Graham says you're not investing. By definition, you're speculating, period.
So how in the world do you stay rational when the market is anything but? Well, Graham came up with this brilliant mental tool to help us out. Let's meet his most famous character, Mr. Market.
Okay, so just imagine you co-own a business with this partner, a guy named Mr. Market. And let's just say he's a little emotional. Every single day, without fail, he shows up and names a price, offering to either buy you out or sell you his share of the business. And his offers are just all over the map, driven entirely by whatever mood he woke up in. On his good days, when he's totally euphoric, he thinks the business is worth a fortune and offers you a ridiculously high price. But on his bad days, when he's pessimistic and terrified, he'll offer to sell you his share for pennies on the dollar. And here's the absolute key to this whole idea. You are under zero obligation to deal with him. You can just ignore him. Or, even better, you can use his crazy mood swings to your advantage. As Graham famously put it, Mr. Market is there to serve you, not to tell you what to do.
So if you're going to take advantage of Mr. Market's emotional offers, you need your own anchor, right? You need a rational, stable way to figure out what the business is actually worth, completely separate from his daily price quotes.
And this is what Graham called intrinsic value. It's not a wild guess. It's a disciplined estimate based on the cold, hard facts, the company's assets, its ability to make money, what its future looks like. This is your number. It's what you believe the business is truly worth, no matter what price Mr. Market is yelling about today.
This quote just brilliantly illustrates the whole price versus value idea. See, in the short term, the market is just a popularity contest, a voting machine based on emotion and hype. But over the long run, the price almost always drifts toward the real weight of the business, its actual performance and value. The intelligent investor's job is to buy when the voting is against it, but the weighing is in its favor.
All right, all of this leads us to what Graham considered the single most important concept in all of investing. This is your ultimate shield, the thing that protects you from bad luck, from your own mistakes, and from a future you just can't predict.
He called it the margin of safety, and it's beautifully simple. You do the work, you calculate what a business is worth, its intrinsic value, and then you only buy it when it's selling at a significant discount to that price. That gap between the real value and the price you pay, that's your margin of safety. It's your cushion. It's your room for error.
Warren Buffett gave the absolute perfect analogy for this. You don't build a bridge that can just barely hold the weight of the trucks. No way. You build it a massive margin for error. That is exactly how an intelligent investor thinks about buying a business. You don't pay what it's worth. You pay much less, just in case.
Now, what's really fascinating here is how Graham understood that this whole framework isn't some rigid one-size-fits-all formula. It's a mindset, and it has to match who you are and how much time you have.
So he laid out two basic paths. First, you've got the defensive investor. This person wants safety and simplicity. They build a fortress with quality bonds and a nice, diverse portfolio of stocks, probably through low-cost index funds, and then they pretty much leave it alone. Then you have the enterprising investor. This is the person who's willing to roll up their sleeves, put in the time, and do the deep dive analysis to find those mispriced gems for a shot at better than average returns.
And for that enterprising investor, Graham gave a really clear checklist. First, look for companies with strong finances and low debt. Second, demand a long, stable history of actually making money, like 10 years or more. And most importantly, refuse to overpay. Only buy at a reasonable price compared to what the company earns and what it owns.
When you put it all together, Mr. Market, intrinsic value, margin of safety, you arrive at this powerful summary of the entire mindset. You're not trying to be a psychic and predict the future. You're a realist who takes advantage of the predictable cycles of human emotion. You use the market's optimism as a chance to sell, and you use its pessimism as your chance to buy.
And that really brings us to the book's deepest lesson. At the end of the day, great investing isn't about having the highest IQ. It's about having the emotional fortitude, the stomach, to stick with your rational plan when everyone around you is either freaking out or getting swept up in hype. It all comes down to discipline.
So we'll leave you with this final, critical question to ask yourself. Because according to Graham, how you answer this will have more to do with your long-term success than any stock tip or market forecast ever will. Thanks for digging into this with us.